Hello everyone, this is Hybrid Accounts and welcome again to study a new IFRS called IFRS 2. Of course, I've never explained this in this YouTube channel, right? So it's called IFRS 2 share-based payment. That's the word by which it goes, IFRS 2, right? IFRS 2. It's about share-based payment, all right? Whatever standard you study, you need to know actually the main aim of doing this, right? By share-based payment, what do we mean? There are people who do provide services or maybe they even provide goods to the company, but they are not paid cash. Maybe they are paid, it may be cash, but it may be based on shares, right? Yes. Or sometimes they may just be provided with shares. So it came up that there was a need to actually accommodate this way of transaction in the books, right? Previously, it wasn't recorded, but actually, right now, it is being recorded using following this standard, right? So this is all about IFRS 2. So we're going to see several methods of these payments, all right? Now, this is just a summary. So basically, when we deal with share-based payment, there's payments which are called equity settled and those called cash settled. We're going to see one after another, right? But simply speaking, you should distinguish between the word equity. You know, we have the word equity and then we have the word liability. These are the sources of finance, right? Equity and what? And liability. If you have a liability, it means you have to settle it, right? And now, when you create a liability, it means you settle it by cash. That's why you'd have a cash settled here. And maybe when someone just needs to be provided, let's say with a share, right? Maybe just have share options and they will just be provided with shares. We call it equity settled. We settle it by the way of equity in the books, right? Yes. All right. There is actually another way, another method, another payment, which is called a hybrid. So it involves both equity and cash settled, but it is beyond actually our scope here. So basically, we'll have a focus on equity settled as well as cash settled share-based payments, right? For actually ACCA diploma in IFRS, actually the hybrid is also spoken of, but we won't speak of it here. So simply speaking, you can say you have three, although I'm going to speak of two, right? Okay, so share-based payment here now. Of course, as I just told you, the motive behind establishment of this standard was that, as you see, share-based payment schemes have become increasingly common, right? So due to that sheer volume, it came up that it was actually necessary to have a standard, right? So that's why we say share-based payment occurs when an entity buys goods or services from other parties, such as employees, suppliers, and whatever. For example, maybe employees provide services to the organization, suppliers may provide goods to the organization, and so maybe the payment could be in a way of shares, somehow linked to shares, right? Okay, so that's why we say after buying goods or services, the company settled the amounts payable. You see now, settled the amounts payable by issuing its shares or share options. You see, we're going to issue shares or share options instead of paying cash direct. Or there could be another way. The entity incurs liabilities for cash payments. So this one is normal. You say that you're going to pay cash, but you see now that cash, that amount of cash is determined based on share prices. So that's why you also call it a share-based payment, right? Yeah, so you have to know that, right? Okay, so what is the problem now? We say that if a company pays for goods or services in cash, which is normal, an expense is usually recognized, right? We usually say that the company pays for goods or services in cash, we recognize an expense, right? Let's say maybe you have purchased, right? Recognize in profit or loss as purchases. But if a company pays for goods or services in share options, there is no cash outflow, and therefore, under traditional accounting, no expense would be recognized. You see now, this is what was happening. So it could be like transactions were happening, but there was no way of recognizing them in the income statement. You see the problem in statement of financial position. So to incorporate this, IFRS 2 was established. That's why we say if a company issues shares, the claim now to the establishment of this standard If a company issues shares to employees, we say that a transaction has also occurred, right? Not necessarily cash to have flown. You see, the employees have provided a valuable service to the entity. So the entity is obliged to do something, right? In exchange for the shares or share options. And so it is inconsistent not to recognize the transaction in the financial statement because a transaction has occurred, right? We record transactions. So IFRS 2, as you see, it was issued to deal with this anomaly, right? And that's why we say it requires that all share-based payment transactions must be recognized in the financial statements when the transaction takes place. So it's just a normal transaction like the others, right? It's just one among the others. All right, our types of transactions now. I spoke of them earlier, right? I told you we have equity settled, we have cash settled, but also we have the hybrid, right? Hybrid, a combination of both, which depends. In some cases, you could settle with the equity, and in some cases, you could settle with what? With cash settled, right? Something like that. Of course, we're not going to deal with that, so don't worry about that. So when we speak of equity settled, what do we mean? We settle by way of equity. You don't pay someone the cash. You don't make the funds flow, right? You just settle them with equity. You give them shares, let's say, for example. But for cash settled, it means that you have to pay them cash. When you pay someone cash, it means, we have forms of finance, right? If you pay someone with the cash, it means you're settling a liability. So prior to this, you would see a liability established. While for equity settled, you won't see a liability, you just see equity. Kind of any other under other components of equity, you will see the what? The equity. But if you see the equity and you settle by a component of equity, right? But here you would see a liability, and when we settle the liability, we usually give out the cash. So liability for cash, and then equity for equity, right? For equity settled, you would have the equity, not not specific one, we just say other components of equity, but you would settle it for equity, let's say like shares, right? And then you would have a liability, but you would settle it by way of cash. I hope you have got that now. That's why we say equity settled share-based payments are the entity acquires goods or services in exchange for equity instruments of the entity. At the end of the day, ultimately, the company would have to issue shares or share options, right? Well, for cash settled, as you see, the entity acquires goods or services in exchange for amounts of cash, but that cash is determined by the share what? Price. And that's why you call it equity cash share-based what? Share-based payment. All right. Okay, they're just trying to give an examples now, maybe examples of share options and what. I hope you know the meaning of an option, right? Of course, we'll see that in advanced financial management or financial management. The meaning of an option is like is the right of someone, the what? The right, but not the obligation. That's the meaning of an option, right? If you say you have an option, it's like you're not forced to do. You have the loophole to do it, right? You have the loophole to do it, but no obligation. So whenever you see something called as an option, you say it's the right, but not obligation. So you may decide to exercise it, or you may decide to leave it outright, right? Right, your what? Which is not, but not what? Obligation. I hope you have got this point here, right? That's why we say a share option allows the holder to buy a share in the future for a fixed price, usually called the exercise price or strike price. Now, usually when you're told to buy something, let's say you're told, okay, you enter into a contract to be able to buy something for 20. But let's say, but at the time, something cost only 15 in the market. You obviously won't pay 20 because you have an option. It's an option. You may let it lapse. You may leave it, right? So you're going to X this contract, and just go to the market and buy at 15. Okay. But what if you have a contract to buy at 20 and in the market the price is 25? It's obvious you would say this is in the money, it's fine. So let me go and buy for the market at 20 because it's cheaper. Right. So that's why this flexibility of being able to let the option lapse, not to exercise it, comes with its implications. And that's why for options, there is usually a premium paid. the amount you pay at the inception of the contract, which is non-refundable, right? And this is the one that gives you the flexibility to be to choose on whether to exercise the option or not, right? Yes. Okay. So no problem. We're going to see one by one. You need to know how to treat equity settled share-based payments as well as cash settled share-based what? Payments. Let's go direct to the equity settled, right? Now, for example, purpose, you shouldn't waste time on this, right? This is what we're going to do. This is an equity settled. So first of all, you create an equity, right? And then at the time of settlement, you also provide equity, but this equity now would be specified. Maybe it's in form of shares or what. It would be very, very clear. It would be specified. This one is just a normal other component of equity. This is the first one, right? So since you have said this is equity settled, we know that equity is of a credit nature, right? So you'd have to credit equity here. And then on our side here, you'd have to debit either an expense or an asset. It's obvious. If you have an asset, you would say debit an asset. If it's not an asset, it would obviously go as an expense, right? Yes. So you debit that. You know that expenses and assets have a debit nature, right? While income and liabilities have a credit nature. So the entry to equity is normally reported in other components. You see, it's equity, but not specific, just the other components of equity. It's not categorized properly now, right? So share capital is not affected. You see, share capital, you get share capital by that when you go and settle, when it is settled, you get the share capital. That's why you say share capital is not affected until share-based payment has vested. You would see about this vesting and what. Not, don't worry about this, right? Okay, now that we have seen how to recognize, this is the way of recognizing this, right? You know, recognition means incorporating items of income in the income statement or statement of financial position, right? So until this point, we will have already recognized our transaction, right? But now, you know, when you say I'm going to recognize equity, you should obviously say you recognize it at how much. So we speak of measurement. Okay, let's say my equity is going to be worth $10 million, right? And I'll expense the same amount. All right. How do you go about to actually coming up with the actual figure of this equity and expense? How do you do that in the world, right? So what we have to do that is what we are speaking of measurement here, right? So after recognition, you go to measurement. For whatever standard you study, you should always think of how to recognize, first of all, the objective of the standard, recognition criteria, measurement criteria, presentation, but also finally disclosure, how to disclose. How do you disclose that to the users of the financial statement? Those four things are usually very important, right? All right. So measurement now, we are going to see now how to measure this. Okay, the measurement. The basic principle is that share-based transactions are measured at fair value. This is our basic what? Principle. Although this is only possible when you have sufficient information. If there is a lack of information, actually you are going to have a bit of a problem, right? So we are going to see how to deal with this, right? So we have this table down with us. All right. Is there something easy? Okay, before going through this table, you should understand why it is there, right? It is there because, you know, let's say the company pays for goods or what? Or services, and in exchange, maybe the share options they are given, right? So we can just call maybe the instruments, a certain instrument is given. What we know about the instrument? Instruments are just the documents, right? Documentations. So you see, so usually we focus on the fair value of these instruments of ours. But in case maybe it's not possible, you could go and focus on the goods or services themselves. So it's between these two. The first focus is on the instruments, but in case that's not possible, you go back to the goods or services. All right, look at this and you will understand what I'm trying to speak. You shouldn't actually just memorize this. You see, in the transaction with the employees or others providing similar services, you say it could be services or goods, right? Now, in this transaction with employees or others providing similar services, you know, employees provide service to the organization, right? Okay, let's say maybe the company has run out of capacity and has hired some other people just to finish the job. So those people would be providing similar services, right? So in case that is the issue, If yes, then measure at the fair value of the equity instruments granted at the grant date. There could be equity instrument. An example of equity instrument is like maybe the share options, right? Something like that. So fair value is stated at the grant what? At the grant date. There is the date that is agreed. You're going to see the grant date. You're going to understand that, no problem. Okay, let's say that maybe it's something very different that what employees provide. If no, what do you do? If no, you ask yourself the last question. Can the fair value of the goods and services received be measured reliably? You ask yourself. If you can have the fair value of those goods or services, right? If you can have the fair value of those goods or services, then you say, okay, then no problem. If yes, then you follow the goods or services that I showed you here. So measure at the fair value, the same fair value, but of the goods and the services received at the date that we actually what? Received. So you see, okay, at the date of reception, the goods at this fair value, you take that. In case it's not possible to get this fair value of the goods, then you have to resort to the original point and come back here to measure at the fair value of the equity instrument at grant date. So you come back here, right? Come back this point here. I hope you got this too. So that's our principle. Okay. Just after that, now that's just the way of measuring, but we need to know how do we actually measure. That's just the way you either use fair value of goods or fair value of instruments. But now, how do we actually get that value? That's what we are going to look at. Okay. The grant date. What is the grant date now? You know, when we do studies, there is a point of starting, the period of completion, and the end date, right? So the point of starting we call the grant date, the date of entering an agreement, right? The grant date is the date at which the entity and another party agree to the arrangement. Let's say an entity and the employees, or entity and the other providers of goods or services, right? So the date at which they agree to the arrangement, the date of agreement, the start date, right? So maybe they agree to do this maybe within 3 years. Maybe, for example, the entity says, okay, for any employees who stay with us for actually 3 years, we are going to provide them with the share options, right? Let's say for what? For 3 years. So this duration is usually called the vesting period. And at the end of the 3 years, we call this a vesting date. It means after 3 years, what has been recognized in the books is not going to be realized. So if you had equity, then you can maybe convert it into shares. In case people have exercised those options, right? So you have the grant date, you have the vesting date, and this one is the vesting period. The period during which employees, let's say, for example, could fulfill the condition, which would make them actually be eligible for being provided with the share options, right? Yes. Okay. So we speak of the timing here now. We say some equity instrument vest immediately, as you see there, right? There are some instruments which you can say this is today the grant date, but also the vesting date is at the same time. So there is no vesting period. The period is zero between grant date and vesting what? Vesting date. In other words, the holder is unconditionally entitled. So it means that okay, you employee, if you just agree to our employment, we give you shares, we give you share options. You see, no any condition, just sign the contract to work with us. We are going to give you shares. That one we say it vests immediately. But maybe if you are told work with us for 3 years, after 3 years we're going to give you shares. You see, so that one would have a vesting period. So all employees who have stayed for all that period would be considered for the final settlement, right? So in other words, the holder is unconditionally entitled to the instruments, and in this case, the transaction should be accounted for in full at the grant date. Of course, because actually the grant date is the same with the vesting date. So in case maybe you recognize equity in other components of equity, at the same time, you're going to recognize the shares, right? Because there is no time gap there. Of course, this one would be obvious. We're just going to deal with the complex one. However, when the share options are granted to employees, there are normally conditions attached. As I told you, maybe you work with us for 3 years, for example, you could have a service condition. Maybe you complete a specified period of time, like 3 years, I said. So IFRS 2 states that an entity should account for the services as they are rendered during the vesting period. What do we mean by this? As they are what? As they are rendered. If you have to work for 3 years, it means for year one you would have to account for that, year two, and then year three. So you won't wait and say that, okay, let me wait until 3 years have elapsed and then I account for that. No, you're not going to do that. The first year you recognize, second year you recognize, and third year recognize. After this one now, you can say, okay, if there is an option, you can exercise the option and convert the other components of equity maybe to the actual shares, right? So it's just normal. Okay, don't worry about this. Its solving is very, very simple. I'm going to see it right away. This is the vesting date. Now, I've spoken of it already, right? If the date on which the counterparty becomes entitled to receive the cash, you have been told to work with the company for 3 years, 3 years have elapsed. The vesting date, you are now entitled with the share options in case, or whatever instruments that were put in place, right? So the expense recognized at each reporting date should be based on the best estimate. Get this point now. This point is very, very useful. It's normal when solving the questions, but it needs you to be careful. The expense recognized at each reporting date should be based on the best what? Best estimate of the number of equity instruments expected to vest. By saying on the best estimate, you would say on the first year you could have the certain estimate. On the second year, you could be more certain. On the last year, you would be actually certain because the time would have ended. You would actually know the number of employees you have by that time, so everything would go fine, right? We'll see what we're speaking of, right? When you solve the question. On the vesting day, 2 year told the entity shall revise the estimate to equal the number of equity instruments that ultimately vest. That's why I told you the final year is obvious because it will tell you maybe initially maybe you started with 300 employees, but after 3 years you only have 200 employees, so it'd be more accurate. Maybe when you are at the end of year one, you would say, okay, this end of year one, 10 employees have left, but I expect like maybe a further 40 to leave during year two and year three. This is the expectation, so it's not certain. But after 3 years, you would ultimately know the number of employees who have left and the number of employees you actually have who are actually entitled to those equity instruments, right? All right, now let's go down here. This one shouldn't worry you. It's nothing at all. Let's just go. Vesting period, I think I explained it too. It's just a difference, right? From grant date to vesting date, that's what we call the vesting what? The vesting period. So it's no big deal too. Okay, let's see. Let's look at this example now. We'll get everything fine. Okay, look now. On 1st January 2008, Liminal purchased a patent. The fair value of the patent was reliably estimated to be $3 million, right? Fair value of the patent. The consideration transferred was 1 million. You see the consideration now, 1 million of Liminal's own $1 ordinary shares. On the purchase day, the patent had a remaining useful life of 3 years, and the fair value of one of Liminar's ordinary shares was 3.5 on 1st January 2008 and 3.2 on 30 June 28. What X8? Look now. Discuss the correct accounting treatment of the above in the year ended 30 June 2008. Okay, now we need to account for this. Again, the question says on 1st January, Liminal purchased the patent. You see, on 1st January. And remember, is at that date you have the fair value at 3.5, and on 30 June 2028, we have this price at 3 point what? The 3.2, right? Hello, okay. So, as you can see now, you can try and see. We say that, first of all, maybe this is a patent, right? It's a transaction, purchase a patent, and the fair value of the patent was reliably estimated at 3 million. The consideration now was 1 million of Limina's own ordinary shares. You see, the consideration is already the shares, right? It's on shares. So it's kind of equity settled. And on the purchase date, the patent had a remaining useful life of 3 years. The fair value of this one or this one, right? Now you can see now, on 1st January, the patent was purchased directly there. So if you try and say, okay, is there a difference between the grant date and vesting date? We say there is no difference, it's just the same date, right? This is an example of that vesting that occurs immediately. All right, let's go to this solution. We need to discuss the correct accounting treatment of the above in the year ended 30 June 20 X what? X8, 6 months later, right? Okay, so let's go and see. Okay, this is here. So we can see here, the consideration for the patent purchase was 1 million of Liminar's own shares. Okay, and just by seeing that, you obviously observe that this transaction should be accounted for in accordance with IFRS 2 because it's a share-based payment. The payment is based on shares. And now, on the purchase date, all the vesting conditions have been met, and so the transaction is accounted for in full. It means the grant date, at the date of the grant date and the vesting date are actually the same, so you do not have to wait for anything, right? You have to account for it in full. Okay, how do you account for that now? We obviously know that we have the patent, right? And the patent is an intangible what? An intangible asset, an example of an intangible asset. And the intangible assets are explained by referring to I-38 intangible what? Assets. We know that it's a non-monetary asset. That's why we call it an intangible asset that has no physical substance. And so the fair value of the patent can be reliably measured. You know, I-38 uses cost model, but also fair value what? Fair value model. But from the question, it says that the fair value of the patent can be measured and its value is what? 3 million. And so an intangible asset should be recognized for its what? For this amount, right? So you should have an intangible asset at $3 million. And then we say that a corresponding credit, because we say that for this equity settled, we need to debit an asset or expense and a credit equity, right? So an intangible patent is an intangible asset. So I would have to debit the patent at $3 million, and on the credit side, I would have to credit equity at 3 million what? Dollars. That's why you say, and so a corresponding credit for 3 million should be made to equity. Of this, what should we do now? Remember that the transaction occurred on 1st January, but our period ends on 30 June. You can see here, the transaction occurred on 1st what? January, but the period ends on what? 30 June 28. So if we have an asset, of course, it would have to be amortized. It's an intangible asset, right? Yes. Okay. So of this 1 million will be recorded in share capital and 2 million in share what? In share premium. So at first, you would have to do this. This one would be just as other components of what? Equity. You can call it OCE, other components of equity. This is usually what we do first, after which now we recognize this one, right? But now, this one is usually done at the grant date, and then at the vesting date, we usually make the second what? Entries, which should be this way right now. We go and remove this credit of other components of equity. So we reverse it. So we say debit. We debit other components of equity at 3 million. At 3 what? At 3 million. And now, you know, when you remove the other components of equity, it's like you go on and recognize the actual equity, which is the share capital, right? And since we are told that we had the share capital of 1 million, so I would say credit share capital at 1 million. And then after crediting share capital, whatever remains is usually recorded as the share premium. So I would also say credit share what? Share premium SP at the remaining balance 3 minus 1, which gives us what? Gives us 2. You see now, so this is what is done at the grant date, and this was what is done at what? At the vesting date. But now for our case, the grant date and the vesting date are the same. So you can just avoid this hassle and record them all together, right? You can see here now, we have the debit of other components of equity 3 million and the credit of other components of equity of 3 million. So you can just cancel out this, right? You can just cancel this out and just say that, okay, let me combine grant date and vesting date. So let me remove all this sheet, and then I'm going to copy here. So I'll just say debit patent at 3 million, credit share capital at 1 million, and then credit share premium at 2 million, right? And everything is done. But in most cases, there would be a vesting period, so there would be a distinction. You would ultimately have to distinguish between the two, right? That's the issue of vesting. But as I told you, you know, you have an intangible asset which usually amortizes, actually, and so you have to refer to the question. The question told you that the patent had a remaining useful life of 3 years, and I hope you know what to do, right? You need to get the amortization. How do we get the amortization? Or for tangible assets, we call it depreciation. We would say cost minus residual value divided by what? Remaining useful life. Our cost is 3 million. Residual value is not given, so you can presume to be nil. Divided by what? Useful life, which is 3. So 3 minus 0 over 3 equals to 1 year, right? And now look, this happened on 1st January and it's now 30 June. Only 6 months have passed. So we can only recognize the depreciation for 6 months. So that's why we would have to take one depreciation of 1 million for 1 year and multiply by 6 over 12, right? Which would give us 0.5, which is what we see here, the 0.5. So you'd have to make separate entries for amortization, which you know amortization is an expense. So you'd have to debit amortization in the income statement. Debit what? Amortization in the income statement is 0.5. And then you'd have to reduce this, the amount of what? Of patent. So you'd have to credit the patent by 0.5. So the patent would initiate for 3, and then you'd have to remove 0.5, and the patent would ultimately end up being recognized at 2.5 in the statement of financial what? Position. 2 point what? 2.5, right? I hope you got this. And then I think we can proceed. Let's go on and proceed, right? Okay, so we have text understanding number 2 here. It says equity settled shares share-based payment, and I think this one would be an advanced version 1, right? Okay, let's proceed with the question. The question says an entity has a reporting date of 31st December. This is fine. The year starts at the beginning and ends at the very end of the year, right? A normal one. On 1st January 2021, it grants 100 share options. You see now those instruments. It grants 100 share options to each of its 500 employees. All right, it gives them the share options. Each grant is conditional now. You do not just have the options, no, you have to fulfill the conditions. It's conditional upon the employee working for the entity until 31st December 2023. How many years? It means the whole of 20x1, the whole of 20x2, as well as the whole of 20x3. So 3 years, right? At the grant date now, the fair value of which option is $15. Be very careful with this grant date. As for equity settled share-based payments, you usually use the grant what? Date. So even if you are provided with other share options, you can just ignore them, right? Okay, now as I told you, you have the 3 years, but recognize year by year. So year one, you come to year two, and you come for year what? To year three, taking the best estimate possible, right? And that's why you are given information on the first year, the second year, as well as the third year, which will be certain. You will no longer be guessing, right? Okay, so during 2021, 20 employees leave. And the entity estimates that a total of 20% of 500 employees will leave during the 3 year what period. My friend, let's be very careful on this. For whichever year you deal with, you have to get a proper estimate of all the years, right? Now you are told, initially you had 500 employees, but you are told a total of 20% of 500 will leave during the 3 year period. You see now, although you already know the number of employees who have left during year one, but actually the question has already given you, in fact, you only needed the estimate for year two and year three so that you combine them, right? But the bad thing is, this question has given you, I've denied you the information on year two and year three, but it has given you the total, the figure in total. 20% to live in all the 3 year period. So 20% of 500 would be 100, right? So 20% of 500 times 500 is 100. So you'd only remain with 500 minus 100, which is 400. So by the end of year one, we expect to only remain with 400 what? Employees. So be very careful on this. This question could have said that 20 employees leave and the entity estimates that a total, let's say a total of 80 would leave during year two and the year three, or during the remaining period. Right. We, wewe, unaharibu ji, unaharibu. Unaharibu bwana nyanya wapi ji, unaharibu. Ah, ji unaharibu bwana. Ah, ah, ji unaharibu. Wewe, ji, dada, nenda kwa dada. Ji, all right, so as you can see now, so you'd have to have the estimate for year one, and then like you see now, during 20x1, be careful again. 20 employees leave during 20 year one, and a total of this one will leave during the 3-year period. So you have already been provided with the figure for all 3 years, right? So which is 20% of 500, which is 100. So 500 minus 100, you remain with 400. This is year one. You'd come to year two and read the explanations. During 20x2, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 will leave during the 3-year period. You see, it's also giving you information on all 3 years so you can use it. In reality, I would have said this. I would have said, okay, in year one, 20 left. In year two, 20 left. So I have 40. So I expected that maybe the question said a further 20 leave, and the entity now estimates that let's say 40 would live in year three, in only the last year. So I would say the first 20 plus the second 20 plus the last 40, which gives us 80. And I would say, so 80 would be expected to live in the 3-year period, right? The remaining, I would say 500 minus 80. But this information is different now. So learn how to use the information available, right? In case you use maybe 20 and 20, you won't know the remaining, so it would still be the problem. So use the best information available. I hope you got that right. So here, during 20x2, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 will leave. So 15% times 500 is how much? 15% is like 15 times 5, which is 75, right? So 75 would live in, although you are in year two, but the question says it is in the all 3 years. So in year two, I would expect to remain with 500 minus 75, which is 425. This is before year what? For year two. Then after 3 years, you will no longer have to worry, right? Ah, nipige makelele yani. So during 23, a further 10 employees leave. No, this is the end of your, we had the 3-year period and it is ending, so you do not need more estimates, right? So you obviously know that 20 left in year one, 20 left in year two, and in year three, a further 10 left. So it's a total of 20 plus 20 plus 10, which is 50. So in reality, if I initially had 500, only 50 have actually left. So the reality is that I have 450 employees at the end of the year. So these ones will be the ones who are eligible to receive the shares, right? In case the share options, to exercise the share options in case they need, right? Yes. So that's what you can do now. All right, required here, calculate the remuneration expense that will be recognized in each of the 3 years of the share-based payment scheme. Ah, all right, so now let's go to the solution and you see how you would have to approach this, right? Okay, so you need to know how to deal with the year one, year two, and year three. So at year one, you would start this way, right? This is how we measure that figure now. Right. We know that we remained with 400 employees. The good thing is already we did this, right? I would have 400 employees, right? So you have this 400 here, 500 times 80%. We know the 400 already, so you don't have to worry. This is the number of employees, right? We need to know the total number of options. But we are told that it grants 100 share options to each employee. So if each employee has 100 share options and we have 500 employees, what would be the total number of options? I would have to multiply by 100 options, right? By multiplying this, I would have the total number of options. So what I will remain with is just knowing the worth of those options, right? Now, as for the worth of those options, you should obviously take the fair value at the grant date. Do not take at any date the vesting date or what. No, the fair value at the grant date was $15. This one, like you see 15, 15. So you come here, you multiply it by 15. And now the last thing that you need to know, you usually have like 4 things here, right? The last thing you need to know is the vesting period. The vesting period is 3 years, but now you are only at the end of year one, right? So you multiply by 1/3. The 3 means the vesting period, and this one shows the index of the year you are in. So it's year one, right? The first year. right? So you multiply these ones, should be 400 times 100 times 15 times 1 over 3, and would get $200,000, right? So when we just start this at the beginning, you go and record. We said you debit an expense and you credit what? You credit equity. So debit an expense. First of all, let's say I advise you start with the equity. It makes sense and you would know what I'm speaking about, right? So start crediting equity at $200,000, right? Let me abbreviate. I would avoid the 3 zeros. And for the expense now, this means equity, other components of equity, right? And equity is an accumulation of a lot of things in the income statements, right? So the expense, whatever expense you need, you need to take this equity and you minus the previous equity. But since we are just starting, we did not have the previous equity, so I would just say I'm taking 200 minus the previous equity recognized, which is none as regards to the share-based payment, which is 0. So 200 minus 0, I remain with 200, and that's why I would say I would debit an expense of 200 again, right? This one, so they would be equal. So debit expense of 200, credit equity of 200, right? This is what you're going to do. Okay, now we go to the second year, which is 20x2. We do exactly the same thing. You start with the number of employees, which we already got here. We said it was 425, right? So you come here and say, all right, so 425, this one times this one. This shouldn't worry, just take 425. And then how many options for each one? 100 options. If you multiply, you get the total number of options. You multiply by the fair value at the grant date. But now you're in the second year, so you multiply by 2 over 3, 2/3. You get 425. You see now, so that's why I told you. The value obtained before is the value for equity, not for expense, right? So at this point now, you would say, I am going to credit equity at 420 what? 425 would be my equity, but what is going to be all my expense now? To know my expense, I'm not going to say 425. I told you the expense is the difference between equities. So you take 425, you minus the previous equity. What was the previous equity? It was 200, right? The previous equity was here to what? 200. So you just say 425 minus 200, which is here, 425 minus 200, and it gives us 225. So my expense now would be 225, right? Just that way. So you finish up with the last year, 2083. Okay, you go on and do exactly the same thing. Which employee, how many employees would you have remained with? We got 450 here. So we just come here and say 450 times 100 options for each employee, times the grant date, fair value, times now you're the last year, so times 3 over 3. You could just leave it, right? You get 675,000 this way. This is the equity at the end of year 3. To get the expense at the end of year 3, it's easy. You take this equity and you minus the previous equity, right? The previous equity was 425. So 675 minus 425, you have 250 here, right? Mimi kwa zangu napiga vipindi nataka napata naambia najipanage. Okay, so this is what we'll be having, right? So when we go to the financial statements, now this is what it will look, right? It will look like. In the first year, you have the other components of equity 200 and the expense now, right? In the income statement. This is the income statement, which would have the staff cost or the expense. This is the statement of financial position. You would have the other components of it, not share capital, but other components of equity. It's not already properly classified, right? This 200, how did we get it? We took this one minus the previous equity, which was 0. Okay, you get another equity for year 2 and another equity for year 3. How do you get the expense? How did you get this one? You take the difference between equities, 425 minus 200. For third year, how do you get this expense here? You take its equity, 675 minus 425, right? You do that and everything would be fine, right? Okay, now let's proceed with the other sections, right? Okay, now let's just go. So far we have dealt with the service conditions. You have seen the service conditions, right? Okay, now let's go to the performance conditions now. Service condition just said, okay, stay with us for 3 years. Whoever stays with us for 3 years will be fine, right? And we are not done with that. Vale. You know, there is a time that we would have to, I've not shown you how it vests. Those 450 employees can now exercise their option and buy those shares and own those shares so that other components of equity is converted to share capital, right? But we yet to do that, so we'll do that later. Right now, we just need to know how to recognize it initially, right? Okay, so let's go to performance conditions now. So far, we have dealt with the service conditions, but also we could have the performance what? Conditions. They may be attached. The company may say that, okay, maybe you stay with me, but make sure that maybe the profiting goes up by more than 20% so that we get what? The options. For example, let's say achieving a specified increase in entity's profit. Let's say completion of a research project. Let's say achieving a specified increase in entity's share price. So it really depends on what the entity has specified. Okay, so let's go on. So some of them would be considered, but some of them, even if they are given and not met, we don't care about that. You'll see what I mean, right? Okay. So now performance condition, let's say you have other performance conditions other than service conditions. They could either be market conditions or non-market conditions. You have to know the meaning why you speak of market conditions. You know, the way of getting equity involved is the fair value of instruments at a grant date. The fair value already indicates the implications in the market. So what if there is a market condition? You ignore the market condition, but you still use the fair value. Does that make sense? It's like you disregard something here and you take it at the other point. Ah, so you see, a market condition is one that is related to the market price of the entity's equity instruments, right? An example of a market condition is that the entity must attain a minimum share price. Look, a minimum share price by the vesting date for scheme members to be eligible to participate in the share-based payment scheme. You see that? So we speak of the market price here, we speak of the price, but actually the formula of measuring the instruments themselves already involve the fair value. So it's like you're betraying yourself. So we'll see whether we are going to disregard this or consider this. We also have the market, non-market performance conditions, right? With this, are not related to the market price. For example, let's say you are just told that maybe make sure that you have a certain earnings per share figure or a certain profit targets, right? Not linked to the market. So we're going to see how to deal with these ones, right? Conditions attaching to share-based payment transactions. This is a summary. You can have service conditions, which you have seen, but we can also have market conditions or non-market what? Conditions. This doesn't matter much. We need to know the impact. This is what I was speaking of now. What should you do? If you break the market conditions, should we consider them or not? These ones have already been factored in the fair value of the instruments, as I told you. And therefore, I'm repeating again, and therefore, an expense is recognized irrespective of whether market conditions are satisfied. So do not say, oh, market conditions have not been satisfied, so recognize an expense. No, just recognize it. The impact will be seen at the end, at the vesting date, when you actually need to settle that actually equity, which in case it has been recorded in the what? In the financial statements. But just for the case, for the sake of recording the expenses, don't worry about that. Just proceed, right? Okay, but non-market based conditions, these ones are fine because they are not factored into the what? The fair value of the instruments. So they must be taken into account in determining whether an expense should be recognized or what or not, right? So consider non-market based conditions while disregard the market based what? Conditions. I hope we got that point and we're going to see an example, right? Let's see this example on market based conditions. The question says, on January 2021, 100 employees were given 50 share options each. All right, this is fine. This will reverse if the employees still work for the entity on 31st December 2022. How many years? Whole of 2021 and whole of 2022. So it's a total of 2 years. But also, this is the service condition, but you are told, and if the share price on that date is more than $5, you see, share price, it is obviously a market-based condition, so we won't care. Look at the reality now. On 1st January, the fair value of the options was what? $1. Okay, this is fine. Fair value, which is at grant date, right? The share price on 31st December 2021 was $3. All right, you see, it was less than 5. Then would you say, okay, it's not more than 5, so I can't recognize an expense? No, because these are market-based conditions. You nevertheless have to recognize an expense. And it was considered unlikely that the share price would rise to 5 by 31st December 2022. So for both 2 years, the first year and the second year, it wasn't expected that the share price would change, would rise above 5. So in the normal situation, we would say, okay, oh, this is a problem. I got no way of recognizing this expense, but we say no. These are the market-based conditions. The impact is already included in the what? Reflected in the what? In the fair value of grant date of the options, which is $1. So just go on recognizing the expense. 10 employees left during year ended 2021. So in year 1, 10 left, and a further 10 are expected to leave in the following year, right? Required now, how should the above transaction be accounted for in the year ended 31st December 2021? So we have year 1 and year 2, but the question only requires us to show the impact in year 1, right? So we go on recognizing an expense as usual. How do we do that in the world? First of all, you should know the number of employees who would still be with the entity, right? After the end of year 1. You are told here that by the end of year 1, 10 employees left during the first year, right? And a further 10 are expected to leave in the following year. So you already have information for all the years, right? 10 in year 1, expected 10 in year 2, a total of 20. So 20 are expected to leave, but you had 100. How many employees do you remain with? It's 100 minus 20, right? 100 minus what? Minus 20. 100 minus 20, how much do you get? You get 80, right? You see your 80 here. So you expect to have 80 employees. So you need to know that each employee was given 50 share options. So to get the total number of options, I would say 80 times what? Times 50, and this would give me 4,000, right? So after having 4,000 options, now be careful. There are questions which maybe just go beyond asking this first thing. They could give you this 4,000 direct. This is the total options or total instruments, right? Instead of telling you that, okay, 50 left in this one, they give you the product of 50 and 80. So be careful on whether you have been provided with the total. Here you have 50 share options each for each employee. So you have to multiply by the number of employees to have the total options, right? Okay. So after having this 4,000, now you know you need to know the worth of these options. So you go in and multiply by the fair value of the options at the grant date. Always note that. For equity settled, you should multiply by the fair value of options at the grant date. On 1st January, it is when the options were given. So that was the grant date, right? So, and you are told here on 1st January, on that grant date, the fair value of the options was $1. So you say 4,000 times $1, but then you remain with the one last thing, which is you have to time a portion, right? It is the first year, so but you have a total of 2 years, so you multiply by 1/2, right? This is what we're going to do. Okay, let's go to the solution and we would have to see. Here we are. We have spoken of those two, right? That the market condition won't matter. It won't what? It won't matter here, right? So as you see here, at 100 minus 10 minus 10 is 80, times 50 options, times the fair value grant date, times 1/2, and you have 2,000, all right? As I told you, this one gives you the equity, not the expense. So you have to credit equity at 2,000, right? And now as for the expense, I told you, if it's not an asset, then it's an expense. So it's an expense which would be taken to profit or loss. You say 2,000, which is equity minus the previous equity, which is 0. So 2000 minus 0, and you remain with 2000 like this one, right? And so you'll be done. All right, so that's all about the what? Equity settled on that question, but maybe we could look at another example here and look way forward. Okay, let's look at this. Should we do this or should we just let it be? Okay, this is a simple question. You know, maybe the way it has just been written, you can say, oh, what is this? But it's just a normal question. It's not bad. We can just go through it and see what we can do. Calculate the impact of the above share-based payment scheme on Blueberry's financial statements in each reporting period. Don't worry about this. I think the main aim of this is to include the non-market-based conditions so that you apply them right. Don't be afraid when you see the question long this way. They are very simple questions. You can have just a question for more information. What you need to know is you need to know the number of instruments, for example, the options per employee. Options per what? Per employee. Let's say maybe if there are employees, you multiply by the number of employees, you would see employees and the employees canceling. So you want to remain with options. You need to know the weight of options, the fair value of options, the third thing. And last thing, you need to time apportion. Time what? Time fraction. You just say the time fraction. So you have like four things. Time fraction, fair value, number of employees estimated to remain for the whole period, and the number of options per employee. And sometimes you would be given the product, you would be given this number of options already. So these two things would be multiplied already. So beware of that too. Otherwise, nothing, whatever remains is just a normal thing, right? Very ordinary. Okay, so let's proceed here. And what we have, we are told on 1st January 2024, an entity Blueberry granted share options to each of its 200 employees. You see, the questions are just the same. So this was the grant date, 200 employees, each one granted share options to each of its 200 employees. How many options? Not specified. Subject to a 3-year vesting period, provided that the volume of sales, you see now the first point is the service condition, which is staying with the company for 3 years, but provided another condition, provided that the volume of sales increases by a minimum of 5% per annum. You see now, the volume of sales should increase by at least 5%. That's the meaning of a minimum of, right? Through the vesting period. So each year, the volume of sales should be increasing by at least 5%. In the case that doesn't happen, we don't recognize an expense, right? In case it happens, we do recognize. A maximum of 300 share options per employee will vest. So you can see this is the number of options per employee. You see the way it's simple, how simple it is. You already know the number of options per employee, but we do not know the employees who will be available for the whole of 3 years, right? Which you will obtain. And then, as I showed you, you need to know the fair value at grant date. Even if you don't see it right away, but you know that, okay, I need to know that, right? And then the time apportioning. Okay, now this is just further information, right? We are told if the volume of sales increases by an average of between 5% and 10%, each eligible employee will receive 100 share options. So this 300 is just the maximum. So, okay, so between 5 and 10 is 100 share options. Between 10 and 15 is 200 share options. So the more you perform, the more you get the options. Over 15% is 300 share options. You see, that's why the question is long, but actually everything is just the same. At the grant date now, Blueberry estimated that the fair value of each option was this $10. You see now, you'd obviously be provided with this. And that the increase in the volume of sales each year would be between 10% and 15%. The increase in the volume, this was the estimation, right, at the grant date. You know, we don't need the estimation at the grant date. We need to know at the end of each year, right? At the grant date, we only need to know the fair value, but at the beginning, it doesn't matter. We look at the end of each year is when we recognize an expense. So it was also estimated that a total of 22% of employees would leave prior to the end of the vesting what? Period. Okay. So we expected 22% to leave before the end of the vesting period. And at each reporting date within the vesting period, the situation was as follows. You see now, you have been provided. So all this information is just for you. Okay, we have 3 years, 20x4, 20x5, as well as 20x what? X6. Read the question and see. What was the start date? Okay, we started at 1st January 20x4. So you say, oh, so it's fine. At the end of 20x4, the end of the first year. So you say, okay, this is not a blank. We have been provided information that is necessary. So first year, second year, and third year, right? You obviously see now. Employees living in the first year, 8 left in the first year. Further leavers expected prior to vesting date. This is further leavers. You see now. So they gave you 18 year one. Then we expect 18, a total of 18 to live in the total of year 2 and year 3. You see now, which gives a total of 26. Okay, what about the second year? For the second year, we expect 6 to live, but we expect now, 6 live, and we expect 4 more to live. In the third year, 2 live, you see, and we had this annual increase in sales volume, which we are told to look at these ones, right? These are the conditions. We have annual increase in sales volume, expected sales volume increase over the remaining vesting period, and average annual increase in sales volume to date, right? You look at the condition. What was the condition? Look at the condition. The condition said, provided the volume of sales increases by a minimum of 5%. So if we are speaking of the volume of sales, which would increase annually, right? And you have them here, right? You have them. You can see them. Okay, so what we do, we just go to the question and solve it, right? I read the requirement already. Calculate the impact of the above share-based payment scheme on Blueberry's financial statements in each reporting period. Okay, so let's go to the solution and we'll see what we're going to do. But it's actually the same thing, right? You just need to be confident of what you are doing. You see how simple it has been? Just like I told you, you start with year one, right? You take the total number of employees that you expect will leave, right? Okay, come here. In year one, 8 left, and we expected further leavers to be 18. A total of how much? 8 plus 18 is 26. How many employees were there at the very beginning of the year? How many employees did we have? We had 200 employees. So we had 200 employees, and 26 are expected to leave in the 3-year period. 200 minus 26, we have 174 here. Total number of employees, you multiply by the number of options per employee, which is 200, you get the total number of options. After this one, you multiply by the fair value at the grant date, which is 10. You can see here, we have the fair value at the grant date is 10 here. And then, you have the 3-year period. You time apportion it, but you multiply by 1/3, and you get your equity. You see now, you have the equity of 116. You see? Hello, I hope you have seen that. But before that, you have to ask yourself, is this really worth it or not worth it, right? Because you can see, how did you get this 200? How did you get the 300? You look now and know, okay, how did I get the what? The 200? Because this one depended on the what? On the execution, on the performance, right? What was our annual increase here? On the first year, we had the increase of 14% in sales. So you have to know that 14% warranted how many share options? Between 5 and 10, it was 100 share option. Between 10 and 15, it was 200. That's why you have your 200 here, right? 200 share options. So 116, as I told, this is the equity. To get the expense, you take this equity, you minus the previous equity, which is not there. So it's 116 minus 0, which is 116 again, you have your expense. You go to the second year and you do exactly the same thing, right? How many employees did we expect to remain? By the end of year 2, how many employees did we expect to live in the whole period? You have to understand, right? By the end of year 2, we don't mean that from only year 2. Even when you are at the end of year 2, you count employees for the whole 3 years, right? So here you know that 8 left in year 1, 8 left in year 6 left in year 2, and we expect a further 4 to live in year 3. So it's 8 plus 6 plus 4, which is 18. 200 minus total employees before minus 18, you get 182. Here you have it. How many options per employee? You look at the performance, right? The second year, the performance was 18%, the increase in sales. So you go on and look where 18% lies. 18% lies between 15%. Okay, it's over 15%, right? Which warrants 300 share options. So you come here and multiply by 300. Grant date is usually the same case, and here it's the second year, so we multiply by 2/3, right? You get 364, which is equity. How to get the expense? 364 minus 116, and you have your 248. Okay, you go on the last year, right? For the last year, it is usually easy because you'd know the actual people who left. So in year 1, 8 left. In year 2, 6 left. And in year 3, 2 left. A total of how much? 8 plus 6 plus 2, which gives you 16. So how many employees remained? 200 minus 16, and you have 184, right? Okay, how do you get these options? How do you get the 300? You do the same. What was the performance? 16%, right? Increase in sales volume was 16%. But our condition for increase in sales volume, sales increase per year, lies here. It's over 15, which gives you 300 share options, right? So you have the 300 share options here times 10, times 3 over 3, you have 552 equity. To get the expense, you take this one minus this one, you get 188, which is your new what? Expense, right? So I hope you can see that the way how simple it is. It is very simple. You can see, oh, the question was long and wide, but actually there is nothing there, right? I hope you're together on that. And let's keep up to let's pull up our socks to finish up with actually the equity settled share payments, right? Okay. What about after the vesting date now? I told you, you account from the grant date, and then you go on the all vesting period, and then at the vesting date you finalize, right? Remember, on equity it was the other components of equity and not the specific equity reserve, right? Just the other components of equity. Now we are going to change from the other component of equity to the real equity. Let's say the share capital if someone exercises the shares or what, right? Yes. So that's what we're going to do, my friend. Okay. So you're told IFRS 2 state that no further adjustments to total equity should be made after the vesting date. That's obvious, right? This applies even if some of the equity instruments do not vest. Of course, even if it doesn't vest, maybe you promise 500 employees, but only 400 remain with you at that day at last, right? So it won't matter, right? Do not adjust equity. Right. So entities may, however, transfer any balance from other components of equity to retained earnings. Retained earnings is the realized reserve. We have the realized reserve and unrealized reserves, right? Retained earnings is the realized reserve. Since will be done with this transaction and it would have nothing more to do with it, and that's why you can either leave it in other components of equity or you may as well choose to transfer it to retained what? Retained earnings. I hope you got that, right? Okay. So let's read this question and solve it, right? Okay. Now this question is a bit different, but it's just a continuation of what we started. Beginner offer directors an option scheme conditional on a 3-year period of service. Service conditions are usually very, very common, so should be well versed in them, right? The number of options granted to each of the 10 directors. You see, you have the 10 directors. No, they have not mentioned the employees. They are spoken of what? Directors, direct. Right? 10 directors at the inception of the scheme was 1 million, right? So each director was offered one what? 1 million. Each director 1 million. I hope you have seen that. So you can see the total number of options. It would be 1 million times 10 directors, which is 10 what? 10 options, in 10 million options, in case all of them stayed with the entity for all 3 years, right? Okay. The options we exercisable shortly after the end of the third year. Okay, this is fine. Upon exercise of the share options, when you do the option is that you have the right to purchase something, right? Or sell something. Okay, in your case here, you purchase. You have the right to purchase something at a given price, so you choose. If you see it benefits you, you buy. It doesn't benefit you, you let it lapse, you just leave it, right? So those directors eligible would be required to pay $2 for each share of $1 nominal value. So you see, this is the price of the share option. It is called the exercise price or the strike what? The strike price, right? We say that, okay, you are right. You have earned the right to have these options, right? And you can exercise them. But to exercise them, you have to pay $2 for each strike price or exercise price. So you choose. You either exercise or you let it lapse, right? Okay, we're going to see that, right? So you can see now, the fair value of the options and the estimates of the number of options expected to vest at various points in time are as follows. You see now, these are the total number of options expected to vest, 10 million options. Now, they have not given you, okay, this director would leave, this director would remain. They have avoided that because they have seen that you have gone a bit further. So they have given you the product of share options and the number of directors, like 10 million here, right? They already tell you rights expected to vest. So you have 8 million there, 7 million, and 8 what? Million, right? Fair value of the options, we have them too, right? And then we are told down here that at the end of year 3, 9 million rights actually vested at the end of year. What are we required to do now? We have A and B. Okay, starting with A, it says, show how the option scheme will affect the financial statements for each of the 3 years of the vesting period. So it's just the same like we did before. We'll start with the first one. Listen, we have year 1, we have year 2, but also we have year what? Year 3, right? For year 1, what are you going to do? We said you take the total number of options per employee times number of employees. But now, not have the options per employee. We already have the total. And we are told here, rights expected to vest here. Now, be careful, my friend. I told you, you do this at the end of each year. Here, they wanted to confuse you. They told you start of year 1. We deal with the end of each year. So you deal with the end of year 1, end of year 2, and here, end of year what? Year 3. Be very careful. So at the end of year 1, you only have 7 million options. So I would say I have 7 million options. Instead of saying options per employee times number of employees, you already have the options. So you only need to multiply by the value of those options. What is the value of your options now? We said the value of options, we take it at the grant date. Grant date is the start of the year, at the very beginning, and we have it at 0. How much? 0.3. So I would say 7 million times 0. What? 0.3 here. And then at the end of the year, what do we do, right? We multiply with time a portion. So we have to multiply by 1 over what? 1 over 3. So you do that for the first year. Okay, let's go to the solution here that you can see properly. So it's like you see, I have 7 here, I multiply by 0.3 times 1 over 3 time apportioning, and I have 700,000. To get the expense, it's easy. You take the 700 minus the previous equity, which is 0, so you remain with expense at 700. For year 2, you do exactly the same. End of year 2, you have 8 million rights. So it's 8 million times the fair value at grant date, which is 0.3, and then you multiply by 2 over 3, right? This one, you have 1600, and then you deduct 700 to get the expense here, right? And you repeat the same for the last year, which we had 9 million rights or 9 million options, with the value of options being 0.3. So it's 9 million times 0.3, which gives us times 3 over 3, which that's why they didn't write it. 3 over 3 equals to 1, right? 2700 minus 1600, you have 1100 way, right? I hope you have seen that and everything has gone fine, right? Okay, that's just recording and we're done with that. Now let's go to part B. It's just like we did before. Part B now says, show the accounting treatment at the vesting date. Now was our point. Part A, we did it before, right? More than once. We did it thrice actually. So show the accounting treatment at the vesting date for each of the following situations. The fair value of the share was $5 and all eligible directors exercise their share options immediately. Sometimes you won't be given this information on all eligible directors exercise their options. You just act rationally, right? Look, the share was actually had a fair value of $5, right? But what price were you told to buy? You are told upon exercise of the share options, those directors eligible would be required to pay $2. You see how fair it is. You pay $2 for something that is worth $5. That is actually in the money. It's very beneficial. So we expect all fair and sensible directors to exercise this option, right? That's why they have written here, and all eligible directors exercise their share options. You know, sometimes it may happen that something is in the money. Someone may want to exercise, but maybe they just don't have the money, right? But in the exam, if no information is given, you presume that when something is beneficial, the directors would have to exercise, right? Exercising means paying, right? Exercising means what? Means paying. So we have 9 million rights, 9 million options, and directors paid for all of them, right? I'm repeating again. We have 9 million options and directors pay for all of them. Very simple. If you pay for 9 million rights, we have 9 million rights, you pay for each of them for $2. How much cash would the company receive? The directors are given the options to buy something that is worth $5 only for $2. So the directors would exercise. So the directors would pay $2, right? For all 9 million options, right? So 2 times 9 million would be 18 million. So the company is going to receive this. That's why we say debit cash. The company would receive 18 million, right? This is very nice. The next thing you have to do now is you have to understand that at the end of year 3, in the books, we have this equity, and we are trying to convert it into the specific equity, right? It's just the equity under the other components of equity. Now we are going to remove it. Remember, equity has a credit nature. So we are going to eliminate that equity that has a credit nature. Like I told you before, you credit equity and you debit what? Expense. So we're going to undo that, right? So that's why you can see we have debited equity reserve. We have removed that 2.7 million here, right? Very obvious. So you recognize the equity that is general and other component of equity. You receive the cash and then you record the actual equity. What will be the actual equity now? It's very easy, right? You know, when you exercise the share options, it means you receive the shares. The directors receive the shares. So if the directors have received the share, the company would have to show the share capital in the books, right? Very obvious. Of course, even if not told, if we believe that each share option would give rise to one share, right? So since we had 9 million share options, it means we would have 9 million shares, right? Okay, I hope you know this, right? How do we get the share capital? Share capital is obtained by taking number of shares times the nominal value of shares, not the fair value, times the nominal value of what? Of shares. Okay, were you given the nominal value of shares or not? It's here, right? We are told you'll be required to pay $2 for each share of $1 nominal value. That's a nominal value of shares. Share capital should always be recorded at nominal value. The nominal value is the value that is shown in the articles and the memorandum and articles of association, right, by the Register of Companies. So it's 9 million times $1, which gives you 9 million. In the rest, whatever remains comes up with the share premium, right, and excess to the share capital. So you can say 18 plus 2.7 is 20.7. 20.7 minus 9, you have 11.7, and this should be your share premium, right? Just like that, and everything is done. All right, let's go to part 2. Part 2 says the accounting treatment indicates the fair value of the share was 1.5 and all eligible directors allowed the share option to lapse. You see now, the paying price, directors had to pay $2, but the shares are only worth 1.5. You say, oh, the directors won't do this. You know, this is the fair value. If it's a fair value, it means directors have an option to go and buy at the market from the market at 1.5. But you tell them they already have the contract that they can hana or not hana, right? But by incurring this cost, they would say, "Oh, this is bullshit. I already paid the premium before, and it's now refundable. So shit, I'm not going to take this. I'm going to buy straight from the market." So they would let the option lapse. You see, so they won't exercise. So no options are exercised. So this 2.7 million that you see in front of you would remain in the books. So it would either be the choice of the company. You either leave it in the books, or since it would remain forever, the company would have an option to convert it to retained earnings, right? The entity can choose. It is not forced, but it can choose, right? You know, this is the equity. So, and it was a credit nature. So you can debit that equity, other component of equity of 2.7, right? 2.1.7, and take it to retained earnings. Retained what? Earnings at 2.7, right? So we would say that it would be removed there, and it would end up remaining on retained what? On retained earnings, right? I hope you got my point there. And that's all about cash settled, share-based payment. Sorry, equity settled, share-based what? Payments. And now you're going to do is cash settled, share-based payments. All right. Let's take a break a bit, and we'll come back for it. Right? Okay. Thank you.